Thank you, everybody, for attending. This is going to be the most exciting panel of the day. I'm sorry to the other panelists. Just want to say that up front. I'll do a quick introduction of myself. My name is Asad Khan. I'm a former core team contributor at Centrifuge. I'm working on a few things on the side. Have to ask me about it later. I'm really excited. We've got an absolutely legendary panel here today. A lot of OGs, a lot of new faces, but everyone I think on this panel has been around for a while in one way or another. Maybe their projects are new to you, but I think it'll make really good perspective, and the topic is supply and demand for real-world assets, which means we're going to talk about a little bit of everything, a little bit of anything. We'll start with just quick introductions, starting with Chris, and then we can go down the line.
Yeah, hey everybody. Great to be here today and see everybody. I'm Chris. I'm one of the co-founders and CEO of Plume. We build a chain, an ecosystem, and a network focused on RWAs, and so we're one of the biggest ecosystems out there, 180 projects, and focused on RWA-fine composability and all of that. So looking forward to getting into it today.
Hi everyone, I'm Luca. I'm the CEO and one of the founders of M0. M0 is a protocol that facilitates stablecoin issuance across many ecosystems. Stablecoin seems to be a pretty hot topic this week, has been for a while. My ambition here is to make this a very spicy panel about asking the real stuff.
That's what we're talking about.
Asad.
Hi everyone, my name is Gabriel Otte. I'm co-founder and CEO of Dinari. We provide brokerage as a service APIs that offers US tokenized stocks to the world through other brokerages around the world, through neobanks, through wealth management platforms and things like that. The whole idea is to bring Web3 assets and features back to Web2 through our APIs.
Hey guys, I'm Krupetsky. I lead institutional and capital markets business development at Ava Labs. Really from an institutional standpoint, I partner with the whole spectrum of companies from startups like Dinari all the way through to large regulated buy and sell side institutions, Citi, Wisdom Tree, some of which are sitting here today, as they issue and tokenize assets on the Avalanche network.
Rock stars, all of them. So let's get into it, right? Supply and demand. It's hard to have a conversation about supply and demand without talking about macroeconomics in the business cycle. So I just want to, maybe we'll start with Morgan, work our way back, but really the question is, where are we in the cycle? Everyone knows tokenization, real-world assets, it's part of the crypto, larger Web3 kind of ecosystem. Where are we in that context? And then maybe more specifically from each of your views, what does this mean for tokenization? And please, don't everybody be bullish. Let's give the good side and the bad side, because I know we're all bullish on RWAs.
Yeah, so I guess I would say two things. In the first instance, when we're talking about kind of leveraging this technology and really seeing mass adoption, you're talking about upgrading legacy financial services infrastructure from the 1970s. So it's going to take a very long time, and I think a lot of people in crypto are just have an instant gratification relatively type of attitude. And so I think on the one hand, tokenization is not a new concept, and the concept regained in popularity relatively recently in the past 2 years, but you're talking about upgrading old tech and systems that don't talk to each other. So it's going to take a long time. So I think we're still relatively in early stages. From a cyclical perspective in terms of tokenization, historically it's definitely been counter-cyclical in terms of institutional and various companies kind of looking at it and looking at it as a trend. Interestingly, I think because of a lot of the institutional interest that it's garnered, and at the same time we've seen more institutional capital flowing to things like Bitcoin and Ethereum, it has the possibility of actually becoming more pro-cyclical. And even as we enter this next phase, the next bull market, I don't think necessarily it's going to go away. So I think there's an interesting kind of evolution that we're seeing in terms of the pro-cyclicality of tokenization and crypto markets at large.
So I'm tired of hearing words like operational efficiency and interoperability, because I feel like those are the terminologies that people use for why tokenization. I think we're really kind of crippling tokenization when we talk about it that way, because that's the way some of the larger institutions have talked about it, and it makes sense in terms of increasing operational efficiency internally in terms of fund management and tokenization. But I think in the context of where are we, I think we're in this sort of crypto equivalent of in the early 2000s when we used to talk about internet companies and how there are these internet companies and then there's the other companies. And today, we don't use that terminology at all because every company is an internet company. And in the future, probably in the next decade, I think it's going to be very much the same. There aren't going to be sort of finance companies or wealth management companies and then crypto companies. It's all going to be, everyone has to be blockchain. Everyone has to be on-chain, and everything has to be tokenized. And it's not for just for operational efficiency or interoperability. It's really just about sort of globalization and how finance has always tended towards, which is whatever is going to allow us to do the most in a sort of small amount of time, which is not just operational efficiency in isolation. It's actually the entire system. I think the word people used was evolution, but there is going to be a revolution once everything is sort of tokenized.
Yeah, I mean, I agree with everything which was said.
But disagree.
But no.
It's boring if you agree.
No. So far. I have my spicy comments but no, I think that I just want to put like a macro overlay and a tactical overlay. I think the macro overlay, which is interesting in crypto, is that crypto is a pretty resilient sector to macro, because like crypto is tech. Tech, you need to think about profits coming in the very long term. So in order to discount it to the present, low interest rates is good for tech. Interest rates are high, bad for tech, but also good for certain things in crypto, like stablecoins, right? Like, you start bringing more yield, and actually you want to have efficient pipes because people want to access this massive profit share. So you have seen quite a lot of resilience in RWA kind of adjacent projects in crypto, even with interest rates at 5%, which is pretty good. I think that then I have a positive and a negative sentiment comment. Like the positive one is, this sector is massive. I cannot even imagine how like a builder could build in a different space, but obviously I'm biased. But what is great is that you can access certain pockets, certain markets, certain geographies that were very difficult to access in the past. You can do a lot of interesting stuff. On the other side, I agree, we need to be long-term focused, because in certain entrenched markets, very advanced, like here, the financial system is cumbersome, but it works pretty well. And the centers of profits, they lobby a lot. They're very powerful, and they will make our life quite difficult for a while. So you need to have a lot of conviction and patience. You cannot think about just revolutionizing the world in 5 years. It doesn't work like this. But while you wait, you can make serious money attacking certain geographies and customer bases that have been completely left outside of finance for a very long time.
Yeah, maybe just to not repeat what everyone's saying, and maybe I'll play the other side just for the sake of it. I think the conversation around tokenization largely has been nonsense, and I think most of it has been misguided, right? And most of it is a sort of oversimplification of what's actually going on. At the end of the day, look, if we go back in time, it's very simple, right? We're trying to go from desktop and go from like on-prem servers, right, to the cloud, and that was 20 years ago, and we still barely made it, right, in financial services, right? So like the idea that we're all going to jump to a public blockchain is just not a thing, or even a permission blockchain. It's just not a thing. It's just going to take a lot of time, right? And the reality is, it goes back to what Gabe's point earlier, which is, at the end of the day, right, we're all talking about sort of operational efficiency or upgrading a backend and treating the stuff like technology, which is great, right? But the truth is, nobody gives a shit about it, right? And we need to actually make sure that the thing that really matters is economics, right? At the end of the day, economics drive behavior, right? And saving a couple bips here and there is great, and it's not a bad thing. And there's a lot, and especially at scale, it matters a lot. So I'm not trivializing at all. But ultimately, what really matters is making more money, right? And having abilities to find new markets, new products to sell, new audiences to tap into. So it's about the net new thing that drives people into this, right? And motivates us to go into a new system and into a new technology, a new paradigm that is actually attractive enough, and you deal with the sort of shortfalls and downsides, and you go into a new thing. So that's where we're going is today. So the idea that we're just going to transport and take the existing thing, put onto new rails, is not a thing. We didn't even make it the last cycle, right? So the idea that we're going to jump to this one is not a thing either, right? It's going to take time, and we have to find new ways to use it, and new products and new markets and new ways of thinking about it in order to get there.
Yeah, I love it. I think, Morgan, you said something interesting where there's like a chance that we kind of become a more pro-cyclical market. 2 years ago, other RWAs was something no one wanted to talk about in crypto and Web3. We didn't have the RWA summit. That came last year. And that really came, I think, as Luca, you mentioned, when rates rose, right? And then it made sense. The only place you could find an investable opportunity was really in the real world asset market. We've seen that surge. We're seeing rates go back down. I'm not really sure what's going to happen. Macroeconomic takes are outside of the scope of this panel. I mean, go ask your favorite day trader what they think. They'll probably get a better answer. But the truth is, I think it's difficult to see, especially the things you're talking about, Chris, how we actually get there where there's a consistent, persistent demand. If rates go back down, crypto market booms again, do you guys think we're just going to end up in a space where everyone cares about the latest, greatest meme coin still? Or do you think there's going to be more sophistication that comes in? We hear about this a lot, but to your point, Gabe, talking about operational efficiencies doesn't get anyone excited, right? So I'm curious. As this
Speak
kind
for
of,
yourself.
I love that. But as the market turns over a little bit, right, we get kind of this next phase. Where do you think RWAs land? Is it going to be all up only? Is it going to be really big? Is it going to maybe deal with more of a kind of a slump? Well, I'm curious.
These things are always the same. Where look, the days are long, the years are short. Right? The minute it flips, it will flip very quickly, but it takes time, right? And again, I think it goes back to the same thing. At the end of the day, we can think about the macro situation. The macro situation matters a lot, right? But it's always about this sort of individual micro situation. It's like, what are the individual things that are going to motivate people to come in and do things, right? And change things and change behaviors. And so, going to your point on memes, right? Everyone likes to harp on meme coins and everything today. Look, it's true. A lot of it is nonsense, but it is sort of emblematic of what can be done and what's new and different about doing things on chain, right? Are meme coins going to drive institutions into crypto? Absolutely not, right? That's probably not the move in, but it does showcase how you can do a new thing and how things actually move in crypto, right? It's a new thing that can be only done on chain, which is why consumers and retail are coming into this market, right? That's the onboarding story today for most people. That analog has to be applied into an institutional setting as well to get people to come in, right? And is it memes? No, it's probably not. But there are other forms and factors in which brings things in, and that's the sort of orientation to go into and how we think about it. So a lot of things we're doing now are great for first steps. It's not a negative thing at all, right? But it has to be, we have to build on top of it and allow that to compound on.
At some point, I think there's going to be a massive consolidation in the RWA space. Whenever the next crypto boom happens and things along those lines, there's going to be some institutionals that wake up and realize that the true revolution of RWAs is going to come from consolidating the different tokenized assets, the rails that people are building and all that stuff, and put it all together. And then they are the new DTCC. They are the new banking rails. They are the new whatever sort of financial infrastructure that Morgan was talking about. But it only happens, I think, once everyone kind of gets either collaborates together or it gets piecemeal put together by people who kind of see that vision. And I do think that there is going to be a period of consolidation that happens before sort of the next RWA boom that happens.
I would maybe just add, so when we think about the demand side, and I think about the kind of crypto native demand and then the actual liquidity, which sits off chain today. And so to the extent, if and when the kind of crypto bull market comes back, generally speaking, I think protocols will be /feel richer. And so, and generally they're also more sophisticated. So I think there will continue to be a world for diversifying your stablecoin exposure to various money market funds. And eventually some of those protocols might start moving further out the risk and duration spectrum. And there might be kind of more crypto native demand that continues to be cultivated. But from a non-crypto native perspective, I actually think you'll start seeing more and more traditional institutions, neobanks, startups, start to see this world and really start thinking much more about how do we integrate this tech into our distribution channels and offering kind of the capabilities or the new novel asset classes to the users that we already have, the millions of users that are probably already KYC'd. That's really who I'm excited to ultimately end up reaching. And I think institutions are really starting to think about that, but the next kind of bull market will hopefully catalyze that movement and have institutions start thinking about that as opposed to simply looking at the blockchain communities as new distribution channels.
Actually, I want to stay on that topic because I want to talk about investors and the demand side of the equation a little bit, get away from the macro, right? And Morgan, I do want to ask you, because I think of all the people here, Ava Labs, Avalanche has had RWAs and tokenization as a North Star since the very beginning. I mean, the white paper, I think, mentions this is exactly the reason they were building what they're building. But I want to kind of flip the question over a little bit, not just talk about that. What are the lessons learned over the last 2 years? Because I think I'm safe to say that we haven't tapped the investor demand side yet. We haven't figured it out. No one's found the key that unlocks the $1 billion market or the $1 trillion market. So I'd love to learn lessons learned from your.
I think. Well, I mean, there's a lot, but I think again the biggest one is this concept. Like, perfect example. Bear with me. There's a game on Avalanche called Off the Grid that launched 2 weeks ago, and it took like 4 years to build. And at this point, after two weeks, it's garnered millions of users and millions of transactions. And when the game developers built and launched the game, they didn't build an individual game with an individual console, putting the crypto components in people's faces and having them understand and kind of adapt to the user experience. They integrated their game where the gamers were at and into traditional gaming systems and consoles and kind of access points. And so it was offered via Xbox, via PlayStation, via PC, via Twitch, via like Epic Game Store, and so it really met the gamers and the end investor, in RWA terms, the end investors where they were at. So the biggest lesson learned, and what I'm very focused on from an Avalab standpoint, is working with companies that are thinking about a very robust go-to-market and demand and distribution strategy that is integrating with the likes of the Fidelity app, Robinhood, Revolut, neobanks, other types of startups, embedded finance kind of applications where, again, there are users, and that obviously takes a lot longer, but it's so much more meaningful.
Chris,
I mean, look, everyone always asks, where's the demand going to come from, which is the name of the title of this talk, right? Where's the demand going to come from? And people always miss the simple thing, which is, it's actually right in front of us already, right? So Lucas, we'll shill M0 for a bit. Like, at the end of the day, the number one RWA is, to people that don't remember, it's a stablecoin, right? The stablecoin's already here. It's got enormous volume, right? And relative to speaking, right? So what is it? $180 billion in market cap today for the stables in general, right? And on RWAs, this broad category, right? It's what, 12 billion, right, in total, with like very low growth, right? And so you can see that the stablecoin is not only one of the best products in RWAs, it's one of the best products in crypto, right? And it's an RWA, and it escapes the branding of an RWA, right? Because it's just its own thing, it's a stablecoin, right? And it serves, and I think if you follow down that path, it's a very clear roadmap as how this market is going to progress and how to do things, right? It's going to be where there need to be net new things, it goes to third world countries, it goes to neobanks and other places, right? It goes to these areas where you are building new things, new products, where there is inherent demand, and you build things around that, right? And you bring things to that audience. And so I think that, to me, is where things start. Because again, just again, economics drive behavior, and that is a place that very clearly has demand. So if we just follow that path, it tells us everything we need to know about how this market's going to progress.
Yeah, I think few comments here. I think first of all, I fully agree that to move real big pools of money, you need to have quantum leap type of improvements, right? And money move money. Ultimately, you need to convince them. Now, what I also think so first of all, I think agents like money, and agents are lazy. The reason why, for example, like, let's take the stablecoin, like the nomenclature thing, stablecoin real world assets. I hate the terms, both of them. Like I fought a fight and I lost it. So I will still, will use the term stablecoin, I will use the term RWA, but it hurts me inside. I think the point is, so what is RWA? What does RWA mean? To your point, these are just assets, right? So people, we are actually creating a subcategory of a subcategory, and people need to understand, and why do we need to play this category? It's part of what it is. On the other side, I think stablecoin is a great example. Like money. Money, I always joke that money is the most complex mass-adopted product there is. It's very complex. People think about money as a payment tool. Bridge got acquired by Stripe. Everybody's like, oh my God, who cares about it? Money is not payment. So I think what I'm trying to say is that money, behind this concept of money, there are so many intermediaries that just put loans, leverage, derivatives, balance sheets, intermediaries. It's so complex. But at the end of it, there is one simple product. It's a stable coin, one-for-one pegged. Nobody knows how it works. It kind of works. It's fine. But it's very powerful. So I think the idea of the stable coin can be a Trojan horse into traditional finance. It is true, because there is absolute obvious product market fit. The current system sucks, because banks go down, I used to be a financial institution specialist. I needed to wait once a year to go into the pillar 3 of a bank to understand what the bank was doing, maybe. This is just ridiculous, right? So I think what I'm trying to say is that we should learn from the fact that there is this simple product that kind of works. It can be used in so many ways, that is hiding the complexity behind it, and there is so many things we can do behind it. Because now, stablecoins are minuscule. It's 0.2% of, I think, dollar-denominated stable bank deposits, which is like a joke, right? And there is one company, which is Tether, that is actually printing it. Nobody knows how it works, It's okay. They make a lot of, it's like a massive hedge fund, unregulated. It's a 100% hedge fund. Amazing. So we could do it, which we should just package what's behind this product better. Imagine how big it is. This market is going to go to like $1 trillion, $10 trillion, but simple to digest. We should learn, I think, from this, because otherwise it's very complicated. Otherwise, if you really want to have something very specialized as a custom sort of RWA product for a user, then you need to have transformational experience for that user, which now for institutional money managers, there is not, right? I mean, if you're BlackRock, you don't need a token. You just have your Bloomberg desk, it's fine.
On the demand side of things, we have found that the ex-US demand for US denominated assets, USD denominated assets, is insatiable. There's always people trying to move money into the country in all sorts of ways. And the easier that is, the more demand there's going to be. And the easiest way is not through a wallet. And so what we have found at Dinari is we have kind of a direct-to-consumer type of a portal where people can come and buy tokenized stock. And that amounts to about 5% of our traffic. And then 95% of the traffic comes through our APIs, where people are tapping into the opportunity to buy US tokenized stocks through whatever app that they're already using in their country. So we just launched with our partner Facet basically the first official way for people in Pakistan to access US stocks, pretty much for the first time in the country's history. And all of a sudden, you're going to have essentially 100 million people plus that are going to have access to these types of assets that never had access before. And you can say that these are going to be $1, $2, $3 transactions, and some of them are, but some of them are $150,000 transactions. And so there is demand from ex-US to always enter into sort of US assets. And I think that's a huge unlock for, I don't like the RWA terminology either, but for the RWA space in general.
And just to go off, RWA is just to harp on it for a second, there's no other category in the world in which you take things like basketballs and sports cards and Pokemon cards and financial instruments and equities and put them all into the same grouping. Right? So the term RWAs, by definition speaking, is just a loose word that means nothing, right? And that's why when something works, like the stable, it escapes that and becomes its own thing, right? For tokenized equities, we're not going to call it RWA. It's just it's just equities on chain that it's just people can buy, right? So RWAs, by definition, is a failure of imagination to actually understand what we're doing here, right? We have to understand how to pull these individual things out. When it actually finds product market fit on its own, it will change and become its own thing. By definition, by staying in the RWA category, it means it has not found product market fit.
This is the last time you'll see any of us at the RWA Summit. I'm just going to put that out there.
It's just called Summit.
Yeah, the Asset Summit. All right, I don't even know if that would satisfy these guys. But I actually want to stay on this topic for a bit, right? I do want to talk about products and use cases. There's some interesting comments there. But, distribution is the challenge. And there's that saying, right? A first-time founder thinks about product. A second-time founder thinks about distribution. And distribution is kind of the key that we're talking about today. Morgan, you're mentioning meeting the market where it is. You're talking about, let's talk about the users that are actually there. We're talking about the products. And then, Gabe, you're talking about distribution, actually accessing maybe investors and markets.
Well, I'm a second-time founder, so.
Yeah, there you go, right? Distribution's big. But see, one of the problems I see, though, is that, there's a branding problem here. One, we're too associated with crypto, so, investors don't like that to begin with. And, start talking about blockchains, tokenization, wallets, people just usually shut off. And then the other side of it, too, is that, we are relying on partners to access parts of the market that are kind of antithetical to what crypto was supposed to be, right? Infrastructure was supposed to be built outside of banks, outside of the traditional finance system, trying to break and disrupt the system, really to make it better and improve from the first point. But if we're saying there's a brand problem, are we doomed to rely on TradFi brands as distribution app partners the whole way through?
Again, I think that's thinking too short term. In the long term, everything is going to be on chain. And it's to me, it's a matter of when, not if. And today, there is a strong network effect of TradFi, with fiat having so much more liquidity still than all the stables. But at some point, that's going to flip. And when that flips, everything's going to actually accelerate towards the on-chain community. It just hasn't happened yet, so we kind of say, oh, do we have to rely on TradFi or anything I don't see that divide either. Somebody up here in an earlier panel said we shouldn't think of it in terms of us versus them type of thing. I actually agree because there is only us, and in the future, that's where everything is headed anyway.
Yeah, kind of. I'm not sure what I'm trying to say. It's okay, but I think so. What you said before, I fully agree that. I joined DeFi. For me, because for the first time there was people trying to revolutionize the back end of finance and not just like a sleek front end. There was like in London, I used to live in London, like when Revolut came out, they had Lloyd's TSB behind it. It's like very nice front end, but behind was like one of the worst banks you can imagine, right? So so it was like a story about customer experience, which was important. But for me, it was the first time we were trying to revolutionize the back end. Now, it means also it's a B2B2C story. So like the consumer still wants to access through the user interface that kind of works, and behind it you can improve what's happening in the back end. So I fully agree that all these things will converge. Now, what is happening now, I'm not really sure. I was in an interesting panel like a year and a half ago. Not panel, actually. It was a Chatham House rule conversations. I don't know if people are familiar with Chatham House rules, but you have like a meeting behind closed doors, and you need to commit that you're not going to say what has been said by a specific person within that room. And it was most interesting things happening with those rules. And we had crypto people, we had central bankers, we had bankers, very senior people. And the central bankers understand exactly what's going on. So when the ECB writes stupid stuff about crypto or the BIS, because they don't like it, but they know exactly what's going on. The crypto people and the bankers also. And the bankers were very clear, and there was like, we will lobby you until you die, because we don't want to lose our monopoly, the monopoly on bank deposits that we have. So we are going to convince that you need to rely on us for security, because we don't want to be disintermediated. So I think that in the short term, there is going to be some friction here, because there are like center of profits that are trying to defend themselves. So why on earth do you need to have a stable coin that is actually one-on-one backed by a bank deposit? It doesn't mean there is a bank storing gold for you or a Bitcoin. What it means is that you are giving an unsecured loan to a bank you don't even know who they are, and they're probably going to lend some money to people that you're never going to hear from. And then you need to pray that the government is going to bail them out like they did for Silicon Valley Bank. We can do better. But I think in the short term, we need to fight this. There are two different sectors that are fighting. In the long term, I agree that money moves mountains, so people will understand that we're going to be more investors, more talent building, and disintermediating the banks. But I am pretty sure there is friction here. And also, like I think the last point here, and I hand it over, but we had the conversation when we prepped this panel. It's funny, like we built DeFi because we said the current financial intermediation kind of doesn't work, we need to redesign it. So we got a lot of money into DeFi, chasing a dream. And now we're saying, no, we're going to give the money back to, sorry guys, whoever is in the room, to BlackRock to manage it. Why? I mean, let's redesign the way we manage money. Why do we need to take the money and give it back to a fund of BlackRock? So it's a bit of a contradiction in terms. So I think we should be a bit more ambitious as founders.
I definitely don't disagree with the friction in the short term, right? Just to be clear. I was just saying it's going to be slow, 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 and then it's going to be fast when that flip happens. So I agree.
I would also agree, sorry. Although my job description is literally to get banks and asset managers to use Avalanche, so I think inherently, even a lot of the tokenized assets today, even if you talk about stable coins, they all use a traditional custodian from a collateral backing perspective. And so if you think that you're going to go and build this entire ecosystem leveraging financial assets that doesn't touch TradFi, it's not particularly realistic, but I totally agree in that almost like the world of startups and fintechs post-global financial crisis started to disaggregate certain banking services. I think this next evolution, revolution, whatever we want to call it, is just another example of that. And so to Luca's point, I think part of it is going to be where fintech spent a lot of time really kind of innovating on the front end and the UI. The next kind of leveraging of blockchain and tokenization will really upgrade that back-end plumbing, which will really kind of, I think, take things forward.
And kind of staying on the same topic, but switching gears slightly, like Chris, you mentioned earlier that it's DeFi liquidity, right? That's where the market is. Those are the users we're trying to serve today, and there's this great convergence that's going to happen, right? Where TradFi and DeFi kind of become one and the same. But speaking right now about how do you address that opportunity, like how do you think about leveraging DeFi liquidity? I mean, are you focused on that entirely? Is that kind of the way you'd say it?
For Plume, we are, right? It's these things aren't. They're not ors, it's just and, right? And it's a sequencing question. That's all it is to us, right? Which is today, we see the world in a very simple way. If you look at liquidity on chain, it's very simple. 99% of it is in crypto people, right? There's no question about that. 1% is in the trad world, right? And it's changing over time, right? And so you will have things that change, but the products evolve to serve the markets that end up being on chain, right? And so today, we're focused on it. That's why our entire sort of ecosystem, our infrastructure, our technology is all built around a permissionless use case. It's built around an ecosystem. It's built around composability. It's built around a crypto native and a crypto first mindset. But it's not to say that we haven't built a bunch of things that then end up working for more traditional institutions as well. We're beginning to work with them as well. So to me, it's about both. It's a sequencing question. You start here, right? But again, it's to me, again, and so it's probably like belaboring the point. I just start with the end user. It's very simple, right? And who's the end user today? It's all crypto people. And as that changes, the products and the composition of things that you build on top will change as well. So as you use things like Dinari and you access new markets, that will change. If you use things like M0, that will change as well. So like as the audience changes, products will come in to fill the gap. It's just the nature of startups and companies in general, right? And supply and demand. As that changes, things will change. But today, when you address and you try to build a product for a market that doesn't exist, it gives you the volume that most RWA products have, right? Which is something that doesn't exist, right? So you have to start there and then you expand over time.
Yeah, and I think there was like this idea of matching supply and demand. It was at the core of how we designed M0. I think the idea of M0 is like everybody sees how profitable stablecoin is. Everybody wants to issue a stablecoin, but you need to scale your own liquidity. And so you have a lot of like use cases and venues that require digital money, and they end up aligning with one issuer, and they're doing the heavy lifting for the issuer to make money, which obviously is not sustainable. So our idea is that imagine if you had one large venue, like a large exchange, a fintech company, whatever, that could also be an issuer of its stablecoin within its ecosystem. So they bring the demand, and they actually distribute at the same time, which is a very powerful concept, but you need to educate the market, right? But I think we're getting there. Now the stablecoins are starting to be embedded in financial use cases. I mean, the international payments is a Trojan horse, but it's just the first one. You could have so many like neobanks built on crypto rails, and that's what we want to do. And by the way, M0 is hiring. If someone wants to really help us out, guys, I think we're pretty compelling.
I promised there'd be no sponsoring. There'd be no shilling, but I couldn't keep it all at bay. All right, so we're almost out of time. We're going to make it a little bit spicy at the end here. Try to at least. Why don't you guys, I'm going to go down the panel. Maybe you can give me like an answer and like one sentence, couple sentence explanation. And the question is, do you think over the next, let's call it 18 months, will growth in tokenization come from North America or come from offshore? Morgan, let's start with you.
Offshore.
Why?
Well, I think, as an example, I think all the things that Gabe was mentioning in terms of there being pent-up demand, whether it's for equities or even just digital dollars that exists. And I know you don't like the term operational efficiencies, but I think part of the tech is it makes it economically and operationally feasible for these issuers to reach various regions that historically it was economically infeasible to do so via traditional rails, and so offshore.
Offshore, and just to appease Morgan, there are so many middlemen when it comes to gaining access to U.S. securities from ex-U.S. brokers out there. So without saying the terminology, I will say that there is a reason for why there is ex-U.S. demand for U.S. securities.
I don't know. I don't care.
Wherever the money is, you'll go there, huh? Yeah.
Yes.
Yeah.
Smart answer.
Yeah, I mean, look, it's no question it's offshore. It's no question it's also you don't know. Because at the end of the day, the only thing that matters is where's the liquidity coming from, right? And, it's probably going to be offshore, but, the truth is who cares?
All right, well, the truth is who cares? I like that. Go where the money is, people. No, a really great panel. I really appreciate the time. Let's give it up for this panel. It's awesome discussion.